Yesterday's huge rally is a good example on managing stop losses in your portfolio. That's coming up on today's edition of 3 Minutes on Markets and Money. We've talked about managing stop losses before. This is one of the big questions that we get all the time is, Lance, how do you set your stop losses on positions in your portfolio? And it's a great question, and it's also one of these things that investors make a lot of mistakes with. Yesterday's action is a good example of this. Now, normally a lot of people will use a moving average, like the 50-day moving average, or of course the 200-day moving average, as a level to set stop losses. And they say, okay, if a stock breaks that level, I'm going to sell the position and I'm out of it. So let's just use the S&P 500 as a position in a portfolio and as a good example of managing your stop losses and how it works in a portfolio. Over the last couple of days, we talked about the fact the market had broken below that 50-day moving average, but we said that, look, be careful here because the market was very oversold at this point and due for a bounce. And yesterday, that bounce occurred. The problem here is that if you were using the 50-day moving average as a hard stop and you broke that level, you sold everything, you missed that rally yesterday where the markets got back above the 50-day moving average and is very close to now triggering a really short-term buy signal. Now, our longer-term sell signal is still intact here and suggests that we're likely going to have some more weakness within this trading range that we've been in. But here's how we want to actually manage that 50-day moving average as a stop loss level. What we would want to see in order to confirm that the break of the 50-day moving average was indeed valid is really two things. One, we'd want to see a sell signal that was in place. Okay, we have that ingredient, certainly a concern here, but we'd want to see the market more overbought than oversold. And again, when you have a very oversold condition of the market, that suggests there's fuel at least for an interim rally. But the important thing that we want to see to confirm that break of the 50-day moving average and to use that as a valid stop within the portfolio is that we would have a break of the 50-day moving average, a retest of that 50-day moving average that fails and starts the market going lower. In that environment, that's where you actually have a valid confirmation at the retest and failure of that 50-day moving average. That confirms that the break is valid, and then yes, that is where you would clock that as a stop loss level and remove position in your portfolio. Right now, we have a fairly decent buy signal with an oversold condition in place, and that does suggest that this market could very well kind of flop around here a bit more before kind of declaring its next move either higher or lower. So again, it's important not to immediately react to the break of the 50-day moving average. Let the markets tell you whether that stop loss level, wherever it is, whether it's a moving average or a prior low level that you're looking at, or maybe a percentage decline from a previous high, whatever it is, let the market tell you that that stop is now valid and that you need to take action in your portfolio. This will help eliminate some of the whipsaws that occur in markets. And these whipsaws occur quite often. And this is what leads investors to discard using any type of risk management. It's like, oh, I keep getting stopped out of positions, then the market runs right back up. Yes, that happens often. And this is why you're going to want to wait for confirmations of a break of a stop loss before you take some action. Yes, you risk a little bit more downside, but you can reduce the emotional drag of getting whipsawed in a position and helps you hold your positions on longer term. And it'll also keep you from just abandoning the idea of risk management under the guise that, oh, it just doesn't work. Every time I do it, it doesn't work, so I'm just not going to do it anymore. Because when you stop doing it is when risk management typically matters the most. I'm your host, Lance Roberts, for 3 Minutes on Markets and Money. See you back here next time.